Hi friends, welcome back to our channel. Yesterday we have discussed about depreciation methods and derecognitions. So now today we will discuss derecognition. So when the PPE leaves the books, so when to we derecognize? When we need to derecognize our carrying amount of the PPE in the books. So derecognition happens when the control transfer from ours to recipient. Once control has been transferred, the PPE has to remove either on disposal or there is two cases. When we need to lose the control, the route one is when we sold the asset. Say suppose today you have an PPE and tomorrow you recognize that there is no use of that PPE and you sold that PPE. If you sold that PPE, the derecognition will comes and you should transfer the party to the product. Or if you have scrapped any physically discarded with no future use, so you have scrapped that entirely, you disposed that asset, and then we have exchanged from one asset to another asset. We have seen this, right? If we have a commercial substance or not for exchange and all, on that date also you need to derecognize, and then you donated it to others. These are the examples. This is the route one where you lose your control for the PP, and the route two for the particular asset. The main asset definition, if you remember in our initial classes, the future economic benefit should flow to the entity. If there is no such condition is satisfied during the usage of that PPE, then expected the machine has been obsolete. There is no use of this machine. The technology has been surpassed, and though no economic value left in the usage, and then destroyed, physically damaged, or fire accident, or any nothing has been recoverable from that machine because of that fire accident or any accident or theft, stolen by the any other. So in these cases, either you transfer your intentionally, or even though if you want to be able to use, you cannot able to use this because of the non-availability to use, because the technology has been obsolete, or you are unable to use them. Or else if you have destroyed this asset, you don't need to maintain that as an PPE in your book. So then you should derecognize. So derecognize it at what value? So whenever if you sell, say suppose your PPE carrying amount is 20 lakhs and you sold it for 5 lakhs, because you already seen that no usable in your business. So in that case, bank or receivable account 5 lakhs to PPE 20 lakhs, the balance 15 lakhs is lost due to sale of an PPE 15 lakhs. Say suppose if any gain on derecognition, in another case you have sold the same 20 lakhs, you sold it for 30 lakhs. So in that case, if any gain on that PP, this you should not treat this as an revenue under Ind AS 115. You should not treat this as an Ind AS 115 revenue. It is an other income only. Why it is other income? The selling of is selling of the PPE is not your regular business. It is not a regular operation. So you should not treat this as an regular operation income. So gain or loss on any derecognition is not an revenue. It is not. It is an other income only. Why? Sale of an asset is not an ordinary course of the business. It is an incidental to the entity's main operations, unlikely selling inventory. So selling inventory is an PPE. It's an revenue under Ind AS 115, but it is not a selling an inventory. The derecognition of asset or selling of an asset is an, in the derecognition, selling is one of the in operation. So This is not a regular income, but there is one exception for this rule. The exception is like when a few business models sell PPE, uh, sells PPE as their ordinary course. Example: there is one car, and the car business owner generally he can sell his own cars, and say suppose he has 10 cars, he can sell his cars as an inventory also, and then if he's in idle time he can use it for rental purpose, or else out of these 10 cars 5 cars is used for rental purpose and remaining 5 cars will be used for sale. This is an inventory. So these 5 cars whatever generating income is an revenue for them. So for the cars are PPE for them because it is generating revenue and future economic flows to the entity. That is why generally what we say that there are 10 cars, in that 5 they used for rental and 5 used for inventory. So these are inventory he can sell when the business comes, like when any offer received to buy that car he will sell this. But these 5 he use for rental purpose and he creates revenue. In that case these 5 would be PPE for him. But after 5 years he feel that these 5 cars is one in 2 cars out of that 5 cars is not able to and not sustainable to rental purpose, so he moved that as an inventory. So he removed 2 here and 3 he used for rental purpose, he add another 7 units as an inventory. Then on this date he should transfer that asset on the you should analyze that asset value and then create an inventory value to the extent on this date it has a transaction of the PPE sale. And when later say suppose in December month he has converted to inventory and then in the April month he sold it. So at the time of sale, because he converted to inventory and then sell, so that would be the income. So generally it is not a general income, but if he converted that asset to PPE to inventory and then sell, that would be then operating income in that case. So I hope you understand this point. So the expression flows when it is rented, the asset classified as PPE. This we already discussed. When the asset is rented, the asset is classified as PPE. The rental term is ended, so it is held for sale. In that case, you should de-recognize as PPE and then transfer that carrying amount to inventory value. Say suppose at the same your carrying amount is 20 lakhs. That 20 lakhs you transfer to inventory. So your inventory value is 20 lakhs and your carrying value should be 20 minus 20, 0, and you de-recognize this asset. There is no gain, no loss because you transfer that carrying value. And then whenever you sell that asset from year to year, the revenue recognized as a revenue from sale proceed. Say suppose you have sold that for 25 lakh. So you sold it general operative incomes, bill receivables or bank. So this is how you should treat this transaction when you sold the asset. Sometimes generally this is the point. The next point would be the revenue point, but I just want to inform you in the PP is there because the asset transaction is covered here only, right? So I just want to include that PPE concept in this revenue also. Say suppose here you transferred from you used it as a rental purpose and you held for sale and you transferred here for carrying value and then sale. The sale value sometimes could be fixed sale value or variable sale value. If it is a fixed sale value or variable sale value, how should you treat? So we need to recognize how should we treat for the fixed sale value and variable sale value. If it is a fixed sale value, as per revenue principles, you should estimate the selling estimated price. If it is a variable sale value, you should estimate variable price also. Say suppose you sold it for 50 lakhs, the main PP sold it for 50 lakhs, and then variable consideration of 10 lakhs. If that machine is any PPE, if you sell for 50 lakhs, and then the 10 lakhs is for variable fee, they will give this variable fee whenever they satisfied further conditions. Say suppose it machine has to produce 20k production in the next 3 years, then at the end of 3 years they may give 10 lakhs. If they give 10 lakhs production, they will give only 5 lakhs. So in that case you see the all best possible ways, and then you estimate your variable selling price, and you should recognize at the sale of the transaction. Whenever you recognize the sale of the transaction, you should uh, keep the asset side. So when you sell the variable consideration, say suppose you are carrying the amount is 45 lakhs, and if you fixed fee is 50 lakhs, okay, and then the variable consideration is up to 10 lakhs if the machine performs well. In that case, how should you account this? First, banker receivable is 56 lakhs. This because the 6 lakhs you have best estimate value variable fee is the 6 lakh for 10 lakhs. You have created the 6 lakhs is the best estimate value. You have given all presentation value, PV values, and everything, and you recognized this for 6 lakhs. For as per Ind AS 15 principles, 115 principles, you created 56 lakhs is the sale value, and then you recognize as 56 lakhs as the receivable, and then the balance PPE. What is the PPE here? 45 lakhs. You sold this 45 lakhs and you recognize here, and then the difference is that 11 lakhs could be the gain on sale of an PPE because you sold it, right? So the bank or receivable will come in future. In future, if this instead of 6 lakhs, if you get 9 lakhs because the machine performed well, and you got 9 lakhs, in that case you should account that 9 lakhs difference of the 9 minus 6, that's 3 lakhs is an additional income, and adjust that as a prospective basis, not on retrospective. And you should not go 3 years back and adjust that 3 lakhs. You just on the date of the recognition of the additional 3 lakhs, you just book that as a revenue, bank or receivable account, and then account prospectively as per Ind AS 115. That is what he told us. So whenever in the true up value, when its actual outcome is known at the end of the performing period, actual variable balance earned to earn out the 9 lakhs, then against the 6 lakhs provision, the total sale consideration is 59 lakhs, but you already considered 56 lakhs in your previous entry. So the treatment should be prospective, not an retrospective. You should not do the retrospective effect. You should do the prospective basis only. So as per Ind AS 15, this 3 lakhs difference should be the change in the accounting estimate, not in the change in accounting policy. So prospectively, you should adjust this original entity. So suppose in additional entry 3 lakhs to gain or loss 3 lakhs. Don't wait certainty before recognizing the sale. Use the construction best estimate method as per Ind AS 115. The true prospective value should be on prospective basis. I hope you understand this concept. So you should not wait until you recognize that 9 lakhs are actual value. So based on the best estimate, you can estimate that your outcome and account as an revenue at the time of transaction. When in future if any changes, adjust on prospective basis. That is what they want to tell this. You can take this screenshot if you want for future purpose. I hope you understood this, and then we will start diminishing liability, the big idea. Say suppose, what is this diminishing liability? Why Appendix A involved in it? The the most important concept in Ind AS 16 is Appendix A to Ind AS 16. Decommissioning liability. Appendix A applies where present obligation exists to dismantle, removal, or restoration, cleanup, or realization as an asset or site in the future. Say suppose if your asset, the PPE, is the condition that in future you should in future you should have an liability obligation to dismantle the PPE or remove the PPE or restore the PPE or clean up the site or establish the property you have acquired. So in this there are few concepts. One is Ind AS 16 is involved. Ind AS 36, that is the provision liability. Contingent assets provisions are there, the provisions are included, and Ind AS 36 impairment and everything has been included, and then Ind AS 116 also included in this. So generally in these cases, offsource of any oil platform, so any oil company installs any offsource platform units, law requires to remove that after 20 years and restore the stand seabed. So suppose if you want to put in any oil platform source, so you should in underwater you need to create one asset, and you should use that particularly for the sand purpose and all. So in that after 20 years the government put a restriction to you that you should change that uh, oil offshore unit and restore the well and the seabed. So whenever you use the seabed and cultivated little bit, that you should change to the original condition. So this is the one example where the diminishing liability will come. And then government mining company, in the companies extracts minerals, government requires minerals and oils. Most of the mineral companies will do this. So government requires to refill the pits, restore the environment and planting the trees. So this is the one of the obligation to the corporates for the using that particular big PPEs. This we already initiated in the initial classes. What is the decommissioning liability and how should we account that in the PPE? So that you should note that here we just see the changes if any for the liability side, and how should we treat the changes to the asset we are discussing here. And any leasehold properties, internal researchers are build any lease premises. Say suppose you have taken one building and it has 4 floors, sorry, it has 4 floors, and then once you entered, you you put the cabins and you put the parking areas and the cafeteria, and you decided some internal meeting halls, and also you created separate webinar sessions, and also you created few other business operations, and so you changed your business as per your requirements. In that case, once the leasehold is completed, once the 10 years is completed, you should change that leasehold property to the exact requirements in future for the leasehold property. So in that case you should change all your properties on different criterias. So I hope you understand. So in those cases, what could be the changes and how should you treat the changes and all we should discuss in these classes. The initial recognition should be, say suppose this is one example I have given there. So the PPE cost is 100 lakhs. Okay. The estimated decommission liability, say suppose in the previous class we have discussed, right, that estimated decommission liability is 20 lakhs. You use 10% discount rate, and the present value of this dismantling cost is 7.7 lakhs. This is exactly where Appendix A applies. The future decommissioning cost brought into the balance sheet today at present value. Okay. So today the PPE value is this plus this. We should add this. This we discussed in the initial class only. What are the cost components and all. So this decommission liability, present value of decommission liability also cost component. If you want, you can check our in the AS 3 part or two part. You can check these cost components also. So for this you need to pay this 100 lakhs as on date, and in future you should pay this decommissioned liability as a provision. This is where Ind AS 37 is applicable now. So in future we need 36 Ind AS 37. So the provision also created. So this liability over the period it may change because time passes of time means you have created present value is 7.7 lakhs. So in the year 1, and in the year end and the year 2 beginning and the year 2 the interest will come. So this interest is 50,000. So 8 lakhs, this will become 8 lakhs. So due to passage of time this liability will change, and also there is a change in the discount rate changes. So you have considered 10 lakhs, 10% is discounted, but in the fourth year or fifth year you have changed the discount rate to 9% or 12%. So if discount rate changes, the value of the 7.755 lakhs will change, will affect. And also there is a change in the estimated restoration cost. So you have estimated at the time of PPE recognition the change is 20 lakhs, but in future if that change could be so the government has changed the policy, so you should have to incur more expenditure, either 25 lakhs, or you should have to incur less expenditure, either 15 lakhs. Either case would be possible, right? Though change in the estimated restoration cost or change in the discounting factors or other variables what we consider at the time of the calculation, or just a change in the passage of time. Passage of time means you just going forward, what are the changes and all. So these are the three type of changes will come. So for these three type of changes we should divide these two changes as one set and these two changes as second set. So I hope you understand until now. Then where Appendix A applies here. So whenever the liability changes over the time, then how should we treat that change and how should we account that change is the question. So during the passage of time, there is a interest expenditure will come. So you debit interest income, and then your liability will increase to the extent of 20 lakhs over the period of time. So that interest will come. There is no PPE addition during this passage of time because this is only financial cost increase. So your estimate will come. You already recognized your PPE in this case, and you divided because in PPE cost we have tell if your payments are deferred, you should, if your payments are deferred, you should divide interest element and cost element in it. So we have divided out of this 20 lakhs. What is the cost element? What is the interest elements we have divided over the period of time, that interest we will calculate, and then if that interest satisfies any Ind AS 23 concept, borrowing cost concept, in that case out of the 10 lakhs interest, say suppose out of the 1 lakh interest in a year, so 50,000 would be the borrowing cost and balance 50,000 would be the interest liability. So this will expense of this may be added to PPE if it is satisfied borrowing conditions. If it is not satisfied the borrowing conditions, that entire 1 lakh, that when entire 1 lakh should be treated as an asset, as an interest expenditure or finance charges. So there is no PPE value changes if the increase due to passage of time and increased liability due to finance cost. So this is what you should understand in this level. So tomorrow we will discuss subsequent changes of the liability, the change in the restoration cost or discount rate and passage time. The passage time we already discussed. This is the unwinding discount rate, and this is an interest expenditure only. But if increase the liability or decrease the liability, so what are the conditions, and will the PPE increases or decreases. So why PPE will affect, and what are the India Appendix A tells that. And then there is an what method we followed, revaluation model or cost model. How should we treat if it is a revaluation surplus and if you do not have a revaluation surplus? That we will discuss, and then we will discuss these changes and what are the Ind AS 16 and the other changes, and then what are the local standard differences, and we'll complete the Ind AS 16. I hope you understand this class, and if you feel we are putting minimum efforts to understand this Ind AS 16, you please subscribe our channel and share to your friends who require this. Thank you.